Good afternoon. I'm Joe Forte. Thank you all for joining another AmTrust Title Insurance webinar series. This program is on navigating in and structuring around bankruptcy in the COVID age. On this panel, we have a fairly diverse set of experts. We have a portfolio manager who is also a fund. We have an institutional and high net worth workout specialist. We have a debtor/borrower bankruptcy lawyer and an accreditor/landlord bankruptcy lawyer. I'm going to let each of them, when I say their name, and so you can hear the sound of their voice and try to identify them while we're talking. Drew Fung.
Hey, good afternoon, everyone. It's Drew Fung. Joe, I guess you want a brief little intro. So I work for Clarion Partners based in New York, but now in my house, and oversee capital markets, and I'm a portfolio manager for our debt funds and debt separate accounts. So basically making mezz loans and overseeing debt activities for the firm and across 1,200 or so properties that we own on the equity side.
Thank you. Jonathan Mablum.
Hi, I am the CEO of Arcturus, and I appreciate your joining us today to listen to the conversation that we're about to have. Arcturus focuses working with institutional clients and high net worths all throughout the capital stack. We work with tenants, owners, and lenders, the funds. So it gives us a really good perspective in the negotiations because we understand what is important to each of those partners. And as we talk about this later on, we'll see how intermingled everything really is today.
Tom Califano.
Good afternoon, and thank you for joining. This is Tom Califano. I'm the U.S. Chair of Restructuring at DLA Piper, based in New York. As Joe said, my practice is primarily on the company/borrower side, and I also do a lot of buy side in distressed M&A. While there hasn't been, and I think Bob will touch on this also, there hasn't been a real estate down cycle in a long time. We've seen real estate issues in retail cases and healthcare cases that are heavily real estate dependent. So I think we'll see how those things translate to this current cycle.
Thank you. Bob Lehane.
Thanks, Joe, and good afternoon, everybody. I'm at Kelly, Dry & Warren, full-service law firm. I focus primarily my practice in retail bankruptcy cases. As Joe mentioned, we represent landlords, from the largest REITs down to small family-owned landlords of primarily shopping centers, but also many REITs that have single-tenant portfolio matters. And I am, fortunately or unfortunately, involved in the vast majority of all of the retail Chapter 11 bankruptcy cases and many out-of-court workouts. And in the regular course of my practice, I also sit on the unsecured creditors committees in many of these cases. And as a result, I get to view the case from a broader perspective than just the narrow set of landlord issues, and have been involved in, as I said, all of the current Chapter 11 cases that have gone on. And we're really seeing the impact of COVID to the cases that had filed for Chapter 11 and that are now filed after the COVID impact. So look forward to the discussions this afternoon.
Drew, at Clarion, you have about $56 billion of assets under management and about 1,200 properties plus in the portfolio. What are you seeing right now? I can't hear Drew.
Right.
Sorry.
I think you have to start over, Drew.
Sorry.
Drew, start over. I'm sorry.
All right. So I said, Joe, that's a great question. No. We spent the better part of March and end of March and April getting our arms around the portfolio. And of those 1,200 properties, we've got it down to a very granular kind of analysis. And really, what we're seeing, it varies across property type. And what I'll say is the multifamily and industrial properties that we have been relatively COVID-proof in terms of rents paid and tenants requesting relief. There's a little bit here and there, but generally, especially in the industrial sector, we've had a very good experience. When you get to office, it's a little bit more of a mixed bag. Again, our portfolio is a little bit higher, sort of class A minus, and you're not seeing a whole lot of waves there. But when you get to retail and you get to the hotel properties that we own, it becomes a little bit of a different story. So rent collections are, much less, as I think, Robert, you can probably attest to in our portfolio there, sort of sub 50-ish% probably is fair to say. And hotels, we've got not a huge amount of, we own about 50 hotels and we have loans on another 3, 4, 5 of them. And, it's very difficult there. You're seeing requests for forbearance across the board and, some issues there. So that's kind of where everyone knows are the most problems. But, I would say overall on real estate portfolios, it's a very interesting time. And there's not a lot of transactions and a lot of price discovery still remains.
What do you think some of the key things that lenders should be looking for right now from the perspective of your portfolio?
Yeah, as a lender, again, we focus on metrics like debt service coverage and loan to value, and values are difficult to come by these days just because of the uncertainty in cash flow. So what we look for is right now, we have dry powder. We're looking to deploy. We have, we want to do what makes sense, and we're higher leverage, right? We're doing mezzanine, so it's a more structured kind of transaction. And I'd say the key is having the ability to, and it's very difficult, see into at least the next 24 months what cash flows, how stable they'll be. You can endure, like say for an apartment, a level of short-term kind of, people are not paying rents or there's higher occupancy, but with the expectation that it's coming back. So that's probably a more sane property type, easier to lend on today. Industrial, same thing, barely a blip other than some of the smaller tenants, but I think there's so much demand in some of the strong markets. I think as a lender, you can get your arms around that and structure things with a little more, interest reserve or a little more conservatism. And, to the extent borrowers are ready to, need the financing, they have a maturity. In the next 5 years, there's a very large wave of maturities coming. So, maybe more than the wave of maturities that people were talking about after the GFC, which never really materialized. I think over the next 5 years, it's actually in total dollar amount, the number of maturities is higher than those 5 years. So,
I think when we look at those assets and work with people at funds like Drew and other lenders, in particular, we start to look at where were those assets before COVID, right? Were those assets in a healthy position before COVID, right? Because that's really, I think, an important part of this. Because as we know, there were many retail assets that were already under dramatic stress before COVID happened, and it's just kind of accelerated the change, right? So we go through each of those assets and look at them. Where were they before COVID? What's the impact that's going on because of COVID? And then you have to look at sort of the recovery, and the recovery is kind of a sector by sector recovery and also a regional recovery. So, an easy example is city retail streets are not the same as grocery anchored shopping centers, is not the same as a mall. And similarly, hotels right, limited service, right, luxury resorts, and convention centers each will be treated differently, and we can assume that they're going to have different types of recoveries. So we think it's important to sort of look at those underlying assets, their attributes, and that's going to allow us to give guidance either to the borrowers as to the type of restructurings they should be asking for, or the lenders as to how they should be dealing with those borrowers.
So it's clearly very different from the GFC in 2008. This is a different type of, we have to approach it differently. And I guess one of the things I was going to ask all four of you is, based on the proposed rollouts, of the different essential businesses in the next couple of months, do you take that phasing into account when you're looking at the properties, knowing that they can open for maybe 4 months, hotels or sports facilities, et cetera? Are you taking those phase-ins into your consideration when you're making your decisions? And Robert, and you and Tom can address that as well.
Yeah, I would say this one thing that's common in all my conversations with clients is the uncertainty. So you're talking about a phasing in, Joe, which is what people are assuming now. But there's two things that are tough to factor in. It's tough to factor in whether there's going to be a second wave and then a second shutdown. Okay. And healthcare experts are saying that's a real possibility in the fall. The other thing that's difficult to measure, and it's something people talk about, is what is the societal change going to be? Because even if, say, resorts get open, right? Even if they're open and, the healthcare officials say that it's okay to open them and they've got, some social distancing built in, what's going to be the impact on the public? How willing are they going to be to go out and, and get back into, those types of properties? So those are two big uncertainties that people are debating. But you really can't tell what the public will be like. I read somewhere that Carnival Cruises, and you would think that cruises would be the last thing that people would be thinking about, already has a backlog of reservations for when they open back up, planning in August. So I think there's, the old saying is there's no accounting for people's taste. I think that's going to have an impact on the recovery and what it looks like.
And I guess 90%
Tom.
discounts probably account for some of it.
Yes.
Bob?
Yeah, following up on that, before we even get to whether or not the world is going to open up again after a second wave, it's what's going to happen now as we have our slow reopening. This is especially important in these Chapter 11 cases. The real big impact we knew right away was that in a world closed by COVID, there's no way to liquidate inventory, which is the traditional way that lenders realize on their collateral in a Chapter 11 liquidation. And as this world is slowly reopening, we have to ask ourselves, are people going to go to places like Pier 1 and Modell's to sift through store closing sales, as both of those companies are in liquidation mode now? J. Crew, which filed with a plan of reorganization. Are people going to be visiting those, and what are the models going to look like in terms of when you close a store? What's the cadence of the liquidation of the inventory, and do the lenders realize on their collateral? The uncertainty, as Tom referenced, is really extreme right now. It's had a significant impact on trying to determine the outcomes of these reorganizations or sales or liquidations.
Yeah, Robert, that's a great point. I think, for us, with my ownership hat on and all the retail properties, that we have, we've got a good number of requests that came in for rent relief from retailers. But somewhat surprisingly, when we asked them for substantiation of the financial hardship, if you will, for rent relief, a lot of those requests disappeared, or they just felt like they didn't have the time, or there was so much uncertainty they didn't bother filling out the quote unquote paperwork. And so, and on the flip side of that, also, I know you're talking about liquidations, but many of the larger tenants have been paying, and surprising the last 2 months, and now I think maybe we'll get some requests for
Jonathan?
going forward.
And what I think we're going to see is an acceleration, a dramatic acceleration of filings by the weaker tenants, right? Because I think if you go to and talk to the retail community, they know who kind of had, let's call it 1 to 3 to 4 years left in living ramp, and they were going to have to restructure, right? And now under COVID-19, there's this huge stress that the people are feeling, and it's also providing a cover. It's not that I was running a bad company, it's that COVID kind of did this to me. And so now is their opportunity to kind of race to the court in a way and sort of say, look, we're not really responsible for the problems mentally. They can say that to their investors. This is what happened with COVID. And we've seen that with companies as they've kind of announced already. And people knew that they were talking about bankruptcy for the last 2 or 3 years, right? But they use it as a cover. And so what we would sort of expect in the next 3 to 6 months is an acceleration possibly of anywhere between 2 and 3 years of bankruptcy work. And that has a major, major impact, not just on retail as a business, but the real estate itself, right? The pressure that's going to be on landlords to restructure leases, right, in that 120-day period, rather than lose those tenants, is going to be much more dramatic, especially when we start to take into account the potential volume, co-tenancy rules, large anchors having problems. There's a huge amount of pressure that's going to sort of fall onto the owners of the retail themselves.
Thank you, Jonathan. Tom and
There's
Robert.
no doubt about it, Jonathan.
Okay, good. That was going to ask a question. Rob first. Bob?
Go ahead, Joe.
No, go ahead. I was going to ask you to comment.
Sure. I mean, following up on Jonathan's comment, I had a good friend who has heavily involved in both liquidation and as a liquidator, and now shifting over to really the advisory side on the retail company side. Looking into June and July, any company that had an issue it needed to clean up, or that anybody thought was struggling, and that may have even been saying, yes, we have an issue we need to clean up, but we really don't want the disruption of a Chapter 11 bankruptcy. Well, you already have the disruption because of COVID. So you might as well scrub it through a Chapter 11, because there's even less stigma, as if there was any attached to it prior to this. Right now, you've got the disruption of COVID already, and you've got the bankruptcy courts are fully expecting this. From the landlord perspective, the immediate impact, and we saw this play out in these mothball and rent deferral motions, was no rent whatsoever. The traditional concept of the use of Chapter 11 was, when you are in Chapter 11, you must pay the rent, at least starting with the first month, that the second month of the case. And debtors across the board have taken the opportunity to push back very hard on that traditional notion. Landlords have taken it for granted that over the last 25 years or so, we've gained significant ground by amending the bankruptcy code and getting bankruptcy judges all across the country to say, look, if this reorganization is going to work, you have to pay the rent post-petition, and you have to work with the landlords. With the impact of COVID, in cases like Modell's and Pier 1, Craftworks, each of the judges took the debtors up on the request to push back on that obligation to pay rent. And as the situation has rapidly evolved, the landlord reaction and thinking about it has evolved as well, and as have the judges. I thought the judge in Modell's was interesting, because when the request was first made, there was some very aggressive landlord pushback that said, there's absolutely no way you can do this, Your Honor. They have to pay the rent, they're in bankruptcy. And the judge, and I thought rightfully so, said, this is the most significant thing that's happened in anybody's lifetime. I absolutely have cause and the power as a bankruptcy judge to push back on you and delay payment of rent. Immediately right after that, Pier 1 asked for the same relief. Craftworks asked for the same relief. As my friend Ivan Gold said, Modell's was like the headline about these mothball motions on the front page, with a retraction on page 9, because the very next status conference, the next week, the judge said, wait a minute, I've thought about this a lot, and everybody's got to share in the pain. It can't just be on the landlords. Lenders, this is your collateral that you're eventually going to liquidate, and it's in their premises, and you're in bankruptcy. And even if we set aside the traditional notions of you have to perform under your contracts, landlords are entitled to adequate protection. We've gotten tremendous traction with the judges across the board on that concept prior to COVID, and in some cases even greater now, that when the debtor is using our premises, even if they can't open and operate now because the state said they couldn't through no fault of their own, and certainly those tenants have good state law colorable arguments as to why maybe they shouldn't pay the rent, they cannot deny that their inventory is in the store, nor can the lenders deny that their inventory is being kept safe, and the landlords are going out of pocket. The landlords are paying taxes, they're paying insurance, and they're maintaining the premises in the building. So there's a real tension. It's unfolding in bankruptcy court in many different ways now. And we're seeing different reactions, not only on the first wave, but as we've started to open up, you're seeing debtors acting as if things had just shut down and asking for extreme relief that they don't have to pay the rent, even as states have lifted their injunctions and the closure orders have been lifted. And most of the shopping centers across the country, at a minimum, have curbside pickup. So there's been a quick evolution, and it's going to unfold very rapidly. So it will continue to evolve, and it's going to be really interesting to see how it plays out in the various settings. Liquidations are easier to understand. There's a sale process out there. Craftworks was a restaurant brewery that's playing out right now, and Fortress went ahead with a sale transaction and is in the process of buying the company. The most interesting ones, from my perspective, are going to be Neiman Marcus and J. Crew, which went into bankruptcy as prearranged, heavily negotiated debt for equity swaps, but they filed after the company most things had closed down, and they're going to have to slowly reopen and still try to accomplish very, very significant restructurings in a 120-day time period that Jonathan mentioned. So it will be very interesting to see how they continue to unfold. But back to the beginning of the statement, I agree. There's going to be a wave of retail companies that are going to take advantage of the disruptions, and we think there's going to be a lot of this is going to unfold in the Chapter 11 courts.
Tom, do you have a view from the other side?
Yes. Well, I was just going to say, people are talking about retail, but it's not just retail. Okay.
Absolutely.
It's a number of other public-facing debtors that are real estate, and just for this audience, that are very heavily real estate focused, or very heavily real estate dependent, I should say. For example, movie theater chains, okay, theme parks, okay, and then on another level, people don't realize that this has had a very big impact on healthcare. While money's going into the hospitals and federal money's going into the hospitals, you have all of what was deemed elective being put on pause. So all elective surgeries are on pause, all elective procedures, large dental practices, and there's been a lot of, there's been a significant amount of private equity roll up in that area. They all require space. They've all had a pause. And another, I think, where there's a real ticking time bomb is in the skilled nursing sector. Okay. Most skilled nursing facilities are financed through sale leasebacks, through ground leases with rent escalators. They've all had an interruption in revenue. They're all going to be getting hit by class action suits. The class action suits are already starting. So that's an area. So I think one thing that we're going to see in this cycle is a lot of, a number of industries that are real estate related or real estate dependent are getting hit hard. And once again, you have the uncertainty. So I'm working on a deal right now on the company side for a retailer. And we're trying to put into our pre-negotiated plan a toggle so that if there is another shutdown, we don't have to go into a 22, but that's like almost impossible because it's so difficult to negotiate around things that you can't quantify and you can't find the end to. So it's just an observation on what I think is coming.
Jonathan and Drew, I mean, one of the things is in many of these transactions, much like 2008, but very different from a lot of the past transactions, there are capital stacks not only in CMBS or CLOs, there are capital stacks in a lot of transactions. And where do you see the most pain coming in, and how are you dealing with it? There's just a case allowing a mezzanine lender in New York to foreclose because it was non-judicial. How does that, when the mortgagee is stuck with a moratorium and can't do anything, how does that affect the level playing field of the parties? The mortgage lender can't even default the borrower while the mezzanine lender has started its foreclosure. Any thoughts on that? Drew, you invest in mezzanine debt.
Yeah, we do. Well, on the face of that decision, we like it, right? Especially in New York, right? Because we get an automatic standstill from the senior loan to cure whatever we want or not. So I'd say that kind of tongue in cheek. I think one of the issues with that particular decision, though, Joe, is whether or not we as a mezz lender can conduct the UCC sale in a commercially reasonable manner, right? So that's the other side of that argument. Sure, we can foreclose. It's not included in Cuomo's foreclosure ban, right, in New York. But can the borrower come back and say we didn't really conduct that UCC sale in a commercially reasonable manner? So that's tricky. But taking a step back, we really don't necessarily even want to get there on some of these things. But if
you don't
we do,
want the
that's
property.
fine. I mean,
I assume in some cases you don't want the
look,
property.
In some cases that's true. We do own property, but again, we're not in that business. We're not in the loan own business. But be that as it may, I think that the pain that you talk about also happens in the capital stack where you have a securitized senior loan. We have the mezz. There could be a junior and a senior mezz together. So it gets complex. There's a lot of constituents in there, and you're dealing with a servicer and a special servicer. So we saw that last go around in the GFC, and there haven't been that many innovations in servicing that have improved upon the process. I think there's a bit of a backlog at the servicers and special servicers and so on and so forth. So that's where there's some serious considerations and pain and just delays, right? That by the time you may have a forbearance agreement done in a hotel deal, for example, it's going to be 3 months already, and the borrower only asked for 3 months of forbearance to begin with. So you're kind of it's a little bit ironic, but I think that's a problem where you're dealing with other default situations. Again, we don't necessarily want to wind up in bankruptcy. There's some things in our documents as a mezz lender, non-recourse carve-outs, and one of them is bankruptcy. We'll see if that is a deterrent in coming months in many respects. So that's, as a non-attorney, those are the kind of things that keep me up at night and I think about in terms of pain.
So I think as a group, we look at a lot of it similarly to Drew, but we took a step back and we said, what's kind of different from now, compared to 2008? And the first piece is really what caused the problem, right? Because in 2008, we basically had the capital markets frozen, right? And it happened over an extended period of time. We all think about Lehman, but there was a good 12 to 18 months of different types of problems leading up to that issue, right? Some of it was within the real estate market and some of it was outside of the real estate market, but there was a lot of signals that were coming to us and the pain developed over time. Today, it's not capital that's frozen, it's people, right? And that's just a huge fundamental difference, right? And it took absolutely no time. You couldn't have tried to get prepared for this, right? So very few kind of winners, quote unquote, from this issue, because people didn't have the time to really protect themselves. In 2008, when we looked at things, what we were really doing was dealing with the different tranches of debt. It was, incredibly complicated. We handled the Atlantis workout in the Bahamas, and that was in excess of $1 billion of debt, and call it 6 or 7 tranches of debt alone. But what made matters worse is the same party owned multiple pieces in different tranches, right? So we had to figure out how the debt was going to work together, right? But at that time, it was really just focused on the different tranches of the debt. Today, because of where we are in the economy, it's not just the debt kind of that you focused on, the difference between the mezz and the first mortgage. Here, we got to really look at the equity and even the tenants, right? Because if we don't have tenancy or occupancy, at the end of the day, all of these assets are based on revenue. So, to us, kind of a term that's going to really come about, whether it's in bankruptcy or out, is there's just going to be a lot more collaboration, right? The lenders need to work with good owners, and good owners are going to need to work with tenants. And that's the only way they're sort of going to drive value at those assets. And so before, while people were focused sort of on individually winning, I think there's going to be somewhat more of a collective process to get there in this cycle for sure.
Let me
I
ask
couldn't
you.
agree more with that. Look, Joe, if I may,
Go ahead.
John, you're 100% right, because in most instances here where the property is having difficulties and the borrower can't pay, there's no income. So you may want to play as much hardball as you want, but if you really want to wind up with the asset, it's not like you can do anything different. There's the COVID that's suppressing revenues. And it all goes back to what we'll call the obligation chain, and there's some breaks in that, right? It's like the renter or the tenant has to pay rent. They're obligated to pay rent, and to the landlord, and the landlord is obligated to pay their mortgage lender, and the mortgage lender may have leveraged, and they have loans, and they're obligated to pay the banks that have credit lines out borrowed on, and so on and so forth. And so the breaks have come where Fannie, Freddie, and they're giving forbearance across the board, right? And then so are they also giving forbearance on people not paying the loans? But banks and other non-GSE lenders are not obligated to forbear, right? So there's those gaps and differences have caused a lot of trouble right now, and all with the backdrop of nobody really knows what the recovery is going to look like, and where the property will be. So
Do you think there are going to be changes in terms and structures to sort of compensate lenders for a higher risk in this situation, or is that even possible? Is that something that people are thinking and talking about? It's a higher risk. Business has changed. The world is changing. In the midst of the workout, are you going to try to get more protection?
Well, I can tell you.
Yeah,
sorry.
Go ahead, Tom. Go ahead.
I can tell you in some of my deals that we were negotiating before all this hit, okay, terms have changed, okay, and deals that we thought were going to be done on certain terms are being done on stricter terms. And I think that anything that was not really baked before this, you will see changes in terms, and I think you will see smart lenders trying to increase their protection if they're going to enter into some sort of workout.
And I think
Robert?
there are different areas important to
John?
different people, right? You may be, you may have the borrower may be focused more on the personal guarantee, right? The lender is focused on the ability to recover. Everybody has different things. you know, sort of from an advisory perspective, I think that's what's really important. Understanding what's important to each party that's what leads to a deal, because everyone sometimes is just focusing on themselves and they can give certain things, right? So you know, an easy example is that people want sort of, you know, maybe if we take a look at the New York condominium market, right? It's in an upheaval today, right? And you have personal guarantees going on, lenders that don't necessarily want to take back the asset, but they also want to know that there are certain performance standards. So whether there is a restructuring that takes place as it relates to guarantees and a restructuring that relates to being able to give the deed in lieu back, or effectively take that deed back in spring if you don't achieve certain goals, I think that there's going to be a lot more negotiation to sort of get to a place that both people feel, you know, protected and comfortable with what's important to them. And otherwise they end up fighting and keeping Tom and Robert very busy.
Speaking of which,
I
Bob,
think, you know, disruption
You'll need a year
is
of
the mother
interest
of innovation.
reserves. Sure. I was just going to say more specifically, Joe, like you're seeing people add interest reserves where they wouldn't have had reserves just in case, right? To bridge through some COVID period of suppressed income or rents. So there are definitely things cropping up in structures, like Tom was saying, and I'd say the other thing that you'll see, right, is there's a lot of liquidity in the market right now, waiting to pounce on the opportunities, but the bid-ask spread is big between borrowers and lenders and what they'll take, and between, you know, sellers and buyers as well. So there's going to be, I think, less with the amount of liquidity that I see ready to kind of jump on top of any opportunities that present themselves. I think there'll be maybe less changes to structures than we're thinking. But that's me as an optimist with my optimist hat on.
Bob?
Yeah, so I was just going to say, you know, one of my roles at Kelly Dry, I'm the chairman of the Innovation and Client Services Committee. And we like to think that disruption is the mother of innovation. And certainly this is the mother of all disruptions. And I completely agree with Jonathan that I think it's gonna foster collaboration. And I've seen different methodologies playing out in the bankruptcy cases. I was never one that put a lot of weight into mediation. Judge Papalia and Modell's moved the whole rent issue over to mediation, but in front of Judge Sherwood. And it's been a lot more successful and productive than I thought it was going to be, and a lot more transparent than I thought it was going to be. And it's changed my thinking. And I think we're all going to be doing some of that. Certainly, some of the things that we took for certain are gone and maybe gone forever. I'm interested in Tom and everybody else's views, but Tom's views. I've always been a big fan of the out-of-court liquidation or restructuring. I've been involved in some remarkably successful out-of-court liquidations where we were able to avoid the significant costs and expense of the dance in front of the Chapter 11 court and all the extra servicing. And I specifically CompUSA, which was about 11 years ago, we wound down the whole chain and returned 35 cents to all unsecured creditors in 11 months. A significantly successful in terms of the vast majority of other liquidations. And we're working out AC Moore in the same manner now. We're probably going to pay 36 plus cents to all unsecured creditors in a matter of 9 months. But those are so few and far between. I'm wondering if there will be more out-of-court restructurings, out-of-court. Certainly the liquidations are the easiest. The go-forward businesses are the ones that I find very tricky for people to accomplish out of court. But maybe in this world where we all do need to collaborate, and I think the timeline, Jonathan, that you spoke of, that it being so sudden and there being such a lack of revenue, forces people more quickly to really cut to the chase and get to the bottom line. So I'm interested in seeing if more of this actually does play out of court.
Tom, before you answer, could you also fold into your answer the concept of the inability to actually restructure because of the inability to come up with a value for the property or the business?
Yeah. Well, I will tell you this. Setting aside liquidations, because liquidations are liquidations, but On the restructuring side, even where you have to file, because, for example, you've got, public debt that needs to be restructured, and you want to take advantage of the fact that you only, need 2/3, or there's some other reason that you need to do it through a proceeding. There is a lot more cooperation on the front end and a lot more focus on trying to get in and out quickly. So one trend that we've seen over the past few years, and which I think will continue, is quick cases, pre-negotiated cases, pre-packaged cases. But what that means is people have to start the process earlier. And unfortunately, most companies don't want to face the fact, and because it takes a long time to put these deals together, to organize the various creditor constituencies. If you want a short stay in Chapter 11, you need to start earlier. But going to what you're saying, Joe, I mean, first of all, you can't get an appraisal now, right? And one thing that we're having trouble in deals where we would plan on going the 363 sale route. We were going to file and sell the company quickly. There's a problem because buyers, even though they can access, a virtual data room, and you can do management meetings by Zoom, etc., people still want to kick the tires, right? People still want to see the asset that they're buying. And appraisers need to see the assets that they're appraising. So that's a difficulty that I think is complicating restructurings and distressed sales now. And it's not something that you can easily brush aside. The other thing is, and you all know this, if somebody's making an assumption about value and there is a question or a contingency, they're always going to err on the more cautious side, right? No one's going to assume the high side in the value when they're buying into a situation like this. So yes, it's making things more difficult, and it is also, I think, forcing creditors to to change their expectations and lower their expectations.
Robert, would you, we're getting near the end of our time. Could you just comment on, for everybody's benefit, the changes made to the small business bankruptcy? Just an overview of what that is and what do you think that's going to do to the bankruptcy courts, and how will that affect mom and pops and the like?
Sure, be happy to try. So the Small Business Restructuring Act put in place what was called a Subchapter 5, and it was intended to be a streamlined Chapter 11 process that significantly reduced the expense, did away with creditors committees, which was always an expense that added a whole layer of professionals, and has automatic status reports within 60 or 90 days, and a trustee appointed to help this small business restructure their affairs. And they had to do a plan that was 3 to 5 years. And the original limit was no more than $2.5 million, thereabouts, in debt. It was raised in the CARES Act to $7.5 million in debt. And that's tripling, really, the debt size for those small business restructurings. And I'm curious to see whether that has a significant impact on the small businesses that in so many ways are so important to employment and Main Street America. And in my line of the world, those mom and pop retailers that are out there running a restaurant or two, or a store or two, or a storefront service or two, and maybe their debt is $7.5 million or significantly less. Is this a viable tool that will help them through the process? That remains to be seen, but it was a significant adjustment in the CARES Act to triple the debt limit and for availability to that level of Chapter 11. And that, in a nutshell, is what I can tell you about the CARES Act and the small business restructurings.
Could I ask you each to give me 3 or 4 words about what you think is going to happen in the future? Drew?
Way more uncertainty.
Jonathan?
So I think a lot of pain followed with a lot of opportunity. And, you know, that reoccurs every cycle, and we don't expect this cycle to be different, even though a lot of what we're focusing on right now is negativity. The uncertainty leads to value gaps, and that leads to great opportunities in the future, because thankfully, as Americans, we all have a very short-term memory, and we're going to probably return to our normal lives. And it may be not 6 months, but when we return to normal lives over 2 years, that's nothing in terms of an investment horizon.
Tom?
I think we're going to see rippling industry-wide defaults as various industries feel the full impact of this crisis.
Robert?
Yeah, I agree. It's going to ripple throughout many industries. It's going to take longer than we thought it was going to take. I do agree with Jonathan. There will be opportunities and there will be innovation, but it's going to be painful.
Well,
We'll get there.
I'd like to take the opportunity to thank Drew, Jonathan, Tom, and Bob, our panelists, for their insights today, and our sponsor, Steve Napolitano of Amphos Title Insurance, and all of you for watching. Please join us again at the next program we do. Thank you very much.
Thank you.
Thanks, everybody.
Thank you.
Thank you, guys.
Good job, Joe.